Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CoreWeave.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices and want clearer buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K FIAVCRA with VIP indicators. VIP indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence. But please remember, trading is risky. No indicator can guarantee profits, and growing $100 into $10 is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose. This is an affiliate link, so I may earn a commission if you use it at no extra cost to you.
Okay, so our mission today is to look at a company that is quite literally building the physical foundation of the artificial intelligence revolution. We've pulled a ton of data from their recent financial disclosures, institutional flow charts, and even chatter from ongoing tech conferences.
Yeah, and the goal here is to answer one incredibly pressing question for you, which is CoreWeave the ultimate generational pick and shovel investment? Or are we basically looking at a highly leveraged, $30 billion house of cards?
Exactly. It's the ultimate tension in the market right now. And that tension is exactly why it's such a fascinating focus for this deep dive. Because when you look at their Q1 2026 top-line revenue, I mean, the numbers are just explosive.
They really are.
We're talking about $2.08 billion for the quarter.
Sure.
That is a staggering 111.69% year-over-year increase. But as always, we have to look at the other side of the ledger, right? Because right alongside that massive top-line growth, you have these absolutely eye-watering capital expenditures. The polarity on this stock is just massive. You have extreme growth on one hand, and then this extreme capital burn on the other. It's basically a high-wire act being performed at a multi-billion-dollar scale.
All right, let's move into the wealth building context. Because building a long-term portfolio requires distinguishing between, a momentary trend and an actual structural shift in the global economy.
Yeah, totally. Because we see short-term hype constantly in the AI space. Like a new software app spins up over a weekend, goes viral, and then poof, it vanishes. This is entirely different.
Precisely. When we talk about CoreWeave, we are talking about the literal shovel sellers of the AI boom. They aren't out there building the AI models themselves. They are providing the massive computing power required to train those models. And what makes this uniquely relevant for your wealth building strategy is the sheer visibility they offer.
Visibility is usually the hardest part with growth stocks, right?
Yeah.
They're always so speculative regarding future demand.
Exactly. But CoreWeave has a $99.4 billion revenue backlog. Just let that number sink in for a second. That gives you unprecedented multi-year visibility for a high-growth name.
Now let's look at the fundamentals, because frankly, you can't service a $99 billion backlog with thin air. That kind of promise requires concrete, steel, and massive power grids, which brings us to the terrifying part of their balance sheet. There is some deep negative free cash flow happening right now.
Yeah, there is. Let's break down the operational scale first, just to understand where all that cash is actually going. Their active data center capacity just hit 1 gigawatt.
Wow, 1 gigawatt.
Yeah, and to put that in perspective, they were at just 420 megawatts in the year-ago period. They have literally more than doubled their physical footprint globally, and the margins are finally starting to show the benefit of that immense scale. They've doubled from 3% to 7%, with management guiding a return to low double digits by Q4 2026.
That's huge.
It is. The forward revenue projections are massive as a result. We're looking at $12.7 billion this year, scaling to $24.9 billion next year.
But, the reason they're capturing this demand isn't just because they bought a bunch of hardware. I mean, anyone with deep pockets could theoretically buy servers. It's their technological moat that really matters here. They utilize a proprietary bare metal GPU architecture connected via NVIDIA NVLink 72 and InfiniBand, and they wrap it all in their custom software called SNK, which stands for Slurm on Kubernetes.
Which sounds like a foreign language to most people.
Right, exactly.
Yeah.
So for someone managing their portfolio who isn't a cloud network engineer, let's apply the explain, like, I'm 5 rule here. Why does this bare metal thing matter so much?
It's a great question because it really is the core of their advantage. So traditional hyperscalers, think of your legacy cloud providers, they operate heavily on virtual machines. It's basically like having a bunch of freelance workers scattered across different time zones trying to coordinate a massive project over email.
Sounds like a nightmare.
It works, but there's a huge communication delay. And that delay is what engineers call latency. It creates a massive performance ceiling for AI training, which requires constant instantaneous feedback.
Okay, so what does CoreWeave do differently to fix that?
CoreWeave's bare metal setup, using that SNNK software, it removes the virtualization layer entirely. It optimizes the network right from the physical rack level. To go back to our analogy, it's like putting all those freelance workers into a single, perfectly optimized room and giving them a collective hive mind. The communication bottleneck just disappears.
Ah, I see.
Yeah, they make an entire cluster of thousands of hardware pieces behave as a single, unified computing surface. For companies training massive frontier AI models, this results in a significantly lower effective cost per computation.
That perfectly explains the bullish operational side,
Yeah.
but we absolutely have to talk about the balance sheet because it is incredibly heavy. I mean, their liabilities are currently sitting at $50.81 billion against $55.57 billion in assets.
Yeah, it's tight.
And their total debt has surged from $8.2 billion in 2024 to about $30 billion today. And that Q1 free cash flow we mentioned earlier, it was negative $4.71 billion, largely because they spent $7.7 billion in capital expenditures in just 3 months.
Right.
Look, taking on $30 billion in debt to build data centers feels an awful lot like taking out a massive high-interest mortgage to build a luxury skyscraper before you even have a single tenant. If the tech market turns or if AI funding dries up, you are left holding a very expensive, empty building.
I hear that caution, and the leverage is definitely undeniable. $30 billion is a staggering debt load. But the skyscraper analogy is missing one crucial structural piece of the puzzle here.
What's that?
The tenants for the skyscraper are already secured. They literally signed 10-year ironclad leases before the foundation was even poured. That's what that 284% surge in their backlog represents.
The $99 billion figure.
Exactly. That massive figure is anchored by a $21 billion commitment from Meta alone, plus huge capacity expansions from highly sophisticated players like Jane Street and Mistral AI. The negative free cash flow isn't reckless spending. It reflects pre-funded, contracted capacity build-outs. They aren't building on speculation, hoping clients will show up. They are building to fulfill already signed, legally binding contracts.
That's a very fair distinction, but servicing $30 billion in debt still requires everything to go perfectly right in the broader economy.
That brings us to the catalyst timeline, because carrying that massive mortgage requires paying close attention to the calendar, and if you are holding this stock, you need to know what upcoming events could trigger a major repricing.
The first big one on the horizon is the Q2 2026 earnings coming up in late August. The entire market is going to be laser focused on those sequential margin improvements. If they're spending this much money, we need to see those margins moving strictly toward that low double digits guidance they promised. If they miss that, the market will punish them.
Oh, absolutely. We also have the ongoing JP Morgan Technology Conference right now. Industry events like this are crucial because management teams often drop subtle hints during fireside chats about, forward demand trends or upcoming financing strategies. But honestly, the biggest catalyst for CoreWeave might not come from the company itself at all. It might come entirely from the macro environment.
You're talking about the bond market.
Yep.
The 30-year U.S. Treasury yield has been touching 5.18% recently. Let's explain why that matters to you as a stock trader. When you are a highly leveraged, capital-intensive company like CoreWeave, high interest yields are a massive headwind. When debt costs more, every single point of interest eats directly into your future profitability.
Exactly.
If you hold $30 billion in debt, a 1% shift in interest rates is a $300 million difference on the balance sheet.
Which is exactly why the macro picture is a potential rocket ship here. If the Federal Reserve signals aggressive rate cuts, or if those Treasury yields simply stabilize and trend down, it acts as a massive upside catalyst. It instantly reduces CoreWeave's future refinancing costs. It makes their existing debt much easier to manage, which fundamentally improves their valuation. A dovish Fed could spark a significant re-rating of the company's baseline value.
Now let's pivot to the chart, because all of this fundamental tension is creating some wild price action.
The price structure here is volatile, yes, but it is undeniably bullish. The stock has absolutely whipsawed retail investors recently. We saw a very sharp 14.58% pullback over the last month.
Ouch.
Yeah, and that kind of sudden drop shakes out a lot of weak hands investors who get easily spooked. But if you zoom out, despite that volatility, the stock remains 50% above its April lows. And there's a highly specific technical event we need to highlight, the massive gap up on May 21st.
Let's break down the mechanics of that. A gap up means the stock closed on May 20th at $101.28. But before the market even officially opened the next morning, demand was so furious that the very first trade executed at $106.56.
Right.
The price literally skipped over $5. It never traded at 102 or 104.
And what's vital to understand about that specific gap up is that it happened on exceptionally heavy institutional volume. That wasn't a bunch of retail day traders pushing the price around on Robinhood. That was large hedge funds and institutional money managers establishing or adding to multi-million-dollar positions.
Smart money.
Exactly. When institutions create a gap up like that, it implies a powerful breakout from a short-term consolidation base, creating a brand new level of technical support.
But here's where it gets really interesting from a risk-reward standpoint. Despite this clear institutional buying, there is currently a 14% short interest on the stock. That means 14% of the shares traded are actual bets by traders that the price will fall. When you have high institutional volume pushing the price up and a large trapped cohort of short sellers, you have the perfect mechanical fuel for a violent short squeeze.
Let's unpack the mechanics of that for a second. If CoreWeave announces a positive inflection in their margins or even an early debt paydown, the stock price will rise. As it rises, the borrowing fees and margin requirements for those short sellers become unbearably expensive.
They get squeezed.
Right. They receive margin calls, which forces them to buy the stock back at market price just to close their losing positions. That forced buying drives the price even higher, triggering more margin calls for other shorts. It becomes a huge feedback loop of buying pressure. So what does market sentiment look like? Is it a totally polarized battleground?
I'll say. You have absolute titans of industry taking entirely opposing views here. On one side, you have massive institutional accumulation. Vanguard boosted its stake by a staggering 275.6%, bringing them to nearly 28 million shares.
Jump.
And then you have NVIDIA. NVIDIA, which obviously understands the AI hardware space better than anyone else on the planet, nearly doubled its stake in CoreWeave to 11%. They now hold 47.2 million shares, worth roughly $4.9 billion.
You have to look at the underlying context of why NVIDIA is heavily invested in their own client. It is a brilliant closed-loop ecosystem.
How so?
Well, if you're NVIDIA, strategically investing $4.9 billion into CoreWeave ensures that your biggest customer has the prime capital backing required to keep buying your newest, most expensive chips. It secures NVIDIA's own revenue pipeline while allowing them to profit from CoreWeave's eventual operational success.
Wow, yeah. And the broader analyst community is leaning heavily bullish for 2026, backing up that institutional flow. GF Securities initiated a buy with a $162 target. Wells Fargo increased their target to $155, Citi raised to $158, Bank of America upgraded to a $100 target, and Truist Financial is holding at $131. When you aggregate all of that data, the institutional side of the market is betting heavily on the successful execution of that $99 billion backlog.
Beyond the analysts, there's also some fascinating market chatter driving sentiment behind the scenes right now. There are loud, persistent rumors of potential M&A mergers and acquisitions activity focused specifically on data center energy integration.
This is a huge point. Break down why energy integration is the next frontier here.
Right now, power is the ultimate bottleneck for AI. Data centers are hitting the absolute physical limits of the local electrical grids. The market is looking at what companies like Nebius did recently by partnering directly with Bloom Energy for dedicated power solutions.
Oh, I saw that.
Yeah. And the rumor is that CoreWeave might use some of their massive recent debt financing to vertically integrate their own energy supply, perhaps buying a power generation company or securing private nuclear agreements. If CoreWeave owns its energy source, they aren't just a computing company anymore. They essentially become an energy utility. That would be a massive strategic advantage that their competitors couldn't easily replicate.
Okay, that's a brilliant strategic move if it's true. But I have to push back on this impenetrable wall of bullish sentiment. I brought the data, and we need to look at it. If the institutions are buying and the analysts are upgrading and the backlog is secure, why are insiders selling? We just saw insider Brian Venturos sell 375,000 shares.
Yeah.
When the people inside the building, the ones who know the most about the company's actual health, are taking chips off the table while the institutions are rushing in, that contradiction has to be flagged. You always have to watch what management does, not just what they say on an earnings call.
It's a highly valid point, and you always have to track insider flow. It definitely highlights the polarized nature of the trade. Now, insiders sell for many reasons, right? Tax purposes, portfolio diversification, or pre-scheduled 10b5-1 selling plans. It doesn't automatically mean the ship is sinking, but you're right, it is a data point that demands caution.
Now let's talk about the risks. Because ignoring the bear case here could be incredibly dangerous for your portfolio. This isn't a guaranteed win, and there are genuine existential threats to the bull thesis. Let's go back to that debt load. They're servicing $30 billion in debt, and their interest expenses have doubled year over year to $536 million.
That's a lot of cash out the door.
Over $500 million just to carry the debt before you even talk about building new infrastructure or trying to turn a profit. If there is any deceleration in AI workloads from their clients, or if the pricing power on GPUs suddenly drops, servicing that debt becomes incredibly dangerous. You start looking at severe dilution for shareholders, or in a worst-case scenario, corporate restructuring.
The debt is the primary risk, without question. But again, you have to look at the mechanics of how the debt is structured. They didn't just take a lump sum loan, they successfully syndicated a $3.1 billion delayed draw term loan facility, which is backed directly by the high-performance computing infrastructure itself.
Explain that for someone who doesn't structure corporate debt. What exactly is a delayed draw term loan?
Think of it as a massive pre-approved corporate credit card from the banks. But here's the crucial catch. They only swipe that card, and more importantly, they only start paying interest on that specific borrowed amount exactly when they actually need to buy the physical servers for a newly signed guaranteed contract.
Oh, that makes sense.
Yeah, it rigorously protects them from paying high interest on billions in idle cash just sitting in a bank account. And the fact that institutional capital has enough confidence in those contracted cash flows to lend against the hardware itself speaks volumes.
But what about direct competition? Because the landscape is shifting. We just saw the announcement of the Google and Blackstone AI venture. That introduces a massively well-funded rival focused specifically on TPU's tensor processing units, rather than the GPUs that CoreWeave relies on. If hyperscalers start providing a viable alternative architecture at scale, it could pressure CoreWeave's contract terms and completely erode their pricing power.
Google and Blackstone pushing TPUs is definitely a structural threat to monitor. A GPU is a brilliant generalist chip. It can do a lot of things well. A TPU is an application-specific chip built specifically to do AI matrix math. If the industry shifts entirely to TPUs because they get cheaper at scale, CoreWeave's mountain of expensive GPUs looks like a liability. The hyperscaler threat is real long-term. But right now, today, the market tells a completely different story. The market is so severely supply-constrained that pricing on CoreWeave's older generation GPUs is actually moving higher. Think about that for a second.
Wait, hold on. You're saying used tech is appreciating in value. That's like a used iPhone 12 selling for more than a brand new iPhone 15. That defies the core laws of consumer electronics. Hardware usually depreciates rapidly the second it's plugged in.
Exactly. The fact that older chips are commanding higher prices on the open market proves that computational demand still heavily outstrips hardware supply across the entire board. The bottleneck is far worse than most realize. And because CoreWeave integrates so deeply with NVIDIA and uses that proprietary S-Link software, the switching costs for AI researchers are incredibly high. These engineers aren't going to easily migrate their complex models over to a new Google TPU environment just to save a few pennies if it disrupts their entire workflow.
It's a fascinating standoff. You have incredible generational structural demand fighting against a highly leveraged, anxiety-inducing balance sheet.
So with everything on the table, what's the final verdict?
Well, based on the institutional research and technical data we've walked through today, we are looking at a bullish score of 7 out of 10. The core thesis frames this as a high-conviction, multi-year hold. We are talking about a strict 12 to 24-month time horizon.
Yeah, you definitely need patience here.
This is specifically for investors who can tolerate near-term balance sheet volatility to gain premier ground floor exposure to the AI infrastructure boom. You have to be patient enough to let these massive capital expenditures translate into true operating leverage by late 2026 or 2027. It really circles back to that skyscraper metaphor we explored. Yes, there's a massive multi-billion-dollar mortgage, and yes, the construction materials are wildly expensive.
But the tenants are there.
Exactly. When the biggest companies in the world have already signed 10-year leases for every single floor before the door is even open, the entire risk profile changes. The primary question isn't whether the tenants will show up. The question is simply whether management can finish building the structure on time and manage those heavy interest payments in the meantime. That's the balance you have to weigh for your own portfolio.
It really is the ultimate test of execution.
But before we wrap up, I want to leave you with one final provocative thought to mull over. We keep talking about the AI arms race purely in terms of silicon chips and data centers. But based on the sheer gigawatts of energy we discussed today, the true absolute limit to artificial intelligence isn't silicon at all, it's electricity. The next trillion-dollar company might not be the one writing the best AI algorithms, but the one who figures out how to physically power them without melting the global grid. Keep your eye on the energy sector because that's where the real underlying war will be fought.
Wow, yeah. The power grid really is the ultimate bottleneck. That's a great point.
And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $110K with VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.